So we have an awesome day to start out your weekend for you. Mortgage rates are going to come down. How do I know that? Well, that's what we're going to talk about in today's video. So today's big topic is the PCE number, the number one inflation measure that the Federal Reserve monitors. How did it come in today? Well, if you go to the headlines right through here in Yahoo Finance, Fed's preferred inflation gauge shows prices rose at the slowest pace since March of 2021. That's fantastic news. I'm going to show you what's going on in the bond market. But first off, let's check with a former Fed official to see what his take is on, now, is the Federal Reserve going to maybe cut it to July meeting based on these numbers? What can we expect? So let's get over to the interview. Pretty compelling information. Some of these interviews get a little too in-depth, and they talk about terminologies and things like that you might be unfamiliar with. So if I catch something during the video or after the video, I'll try to bring it up to you so you can understand what they're talking about. So without further ado, let's get to today's interview with former Fed official. Let's get to it.
Coming up, the estimates for 2.5%. If it comes in line, maybe even lower, I want to ask you, a lot of chatter about this at the New York Stock Exchange yesterday. Does that possibly make the July meeting a live one where we could possibly see a move?
I don't think that it will make the July meeting a live one where you could see a move. The Fed has said many times that it needs to have increased confidence. And so I think what will likely happen in July is they'll signal that they're achieving that increased confidence, thereby cementing the possibility of a September cut. So I don't think July becomes live. I think it is a transitional meeting where it's the communication that matters as opposed to the actual move in the Fed funds rate.
So yesterday, a lot of spirit.
Okay, go right through there. It says odds for a 25%, 25 basis points rate cut. CME FedWatch tool. That's the tool we use on a daily basis. I'm going to get to that in a second, but I just wanted to point that out. They also use the CME FedWatch tool.
Spirited discussion about that GDP report coming in much stronger than expected. I want to ask you, how does the Fed read that? And then also, how do they read the chain-weighted price index? Came in considerably lower than expected.
So look, I think they read the GDP as a good signal. The economy is clearly strong and is withstanding these higher rates. It also is a signal that they don't have to move precipitously to cut. And that goes to your second question. There are some signs of weakness that are starting to emerge, chain-weighted numbers. Also, the labor market is clearly, getting back into balance, maybe moving a little bit to weakness. So I think they put all of this into a mix that says, we are achieving, hopefully, what will be a soft landing. We can wait until September to cut. If that GDP number had come in dramatically weaker, that might have put July on the table. But I think that number simply gives them the confidence that the economy is not sinking. Consequently, they can wait for some more data and move, as probably most people expect, in September.
So you say they can wait for some more data. Consensus is that cut is coming up in September, as we mentioned earlier. In your mind, is there a risk that September may be too late, that the cooling of the economy may be going too far, and that we may just miss that so-called soft landing?
Well, this is why that most recent GDP reading is so important, because it does suggest that the economy is still holding up quite well, even as we see labor markets getting into balance and as we worry about, sort of other risks that are starting to emerge to the so-called dual mandate. And so I think the reason many of us who are expecting to cut don't see that in July, but do see it in September, is that, in fact, they're not confronting an economy that is falling precipitously and putting at risk what we hope to be a soft landing.
So, Roger, there's an elephant in the room, the huge changes when it comes to the presidential election. Is that something that the Fed is considering or weighing in any way when it comes to their decisions?
I doubt it. They have an obvious obligation to focus legally on their dual mandate. The history of the Fed shows that whenever someone at the Fed starts to become, overly involved in politics, they end up making, a wrong decision. Arthur Burns is not well regarded because he gave in to some pressure from the Nixon White House. So I think at this stage, the Fed wants to stay completely above the fray, wants to be able to justify its actions based on incoming data and a changed outlook, and not leave open the possibility that anyone thinks that they're being driven by politics in this particular year.
Great interview. Great interview. It condensed a lot of information in there. So what I want to do is show you right now what's the effect of the bond markets. So this is what we focus in on when you're in the mortgage business. It's what's called the MBS, which is a mortgage-backed security or mortgage bond. Okay, so what we follow to figure out what's going on with mortgage rates, here's the mortgage bond that trades on Wall Street, okay? This is the price of the bond. Most of these analysts or most of these charts are going to show you the yield. The odd thing with the MBSs is they show you what the price of the bond is. So you have to kind of do the conversion in your head. So all you need to do is this. When you're looking at these numbers, let's get to a one-day chart. Oh, we are on a one-day chart. Man, it is way up there. It's up, 13 ticks. Not a bad day going on right now. So what this means is when a price of a bond goes up, it doesn't matter what bond it is, but in this case, it's a mortgage bond. So when mortgage bond prices go up, the yields or your interest rate goes down. We love when they go up. Let's look at like a 10-day chart or 1-month chart to see how it's going. You can see there, it's not a bad move up. Let's go over to here. But if you look at this, let's go to a 5-year. You're going to see this is, again, when these go down, rates are going up. That's when we went basically from, rates in the 3s, 4s, and 5s all the way down to here. Now I'm probably off on my years. No, this goes back several years. So this is when rates were like 3%. Okay, and this is the deterioration in the bond prices driving up those yields to yields that we saw back in here. This was October of last year. The highest rates we saw, they peaked over 8%, and now we're right through here. Where are rates today? They're right through here at 6.91 is the 30-year fix, just the basis for 30 years fix. That's probably going to come down to at least 6.85. Could it get all the way down to 6.8? Only time's going to tell on that part of the equation. Let's get over to the stock market. Everything's loving this today, and I was surprised because when I got the initial number on the PCE, I was like, yeah, it's kind of in line, but how are the markets going to treat this? Well, the Dow Jones was up 600 points a little bit ago. It's still up almost 500 points. S&P's up 40. NASDAQ, it's on shaky grounds a little bit right now because of all the tech stocks and the conversion from tech to a lot of growth stocks and things like that. So we still have the NASDAQ up almost 80 points. So that's good. Let's look at cryptocurrency. It is taking off once again. It's back over $67,000 a coin. And let's go to oil. Oil prices, hopefully, are down. So that means the gas prices in Chicagoland will be going up because we don't really follow oil prices here. So that's that part of the equation. Let's get over to this. Now, this is the conundrum that I have, whatever the conundrum means. You go over to this, and here's my take on it. Yesterday, this is the CME FedWatch tool. Remember, I'm like, hey, check out on the video the CME FedWatch tool. We use that as well. What is the FedWatch tool? Well, it's this. It's saying in 5 days, the Federal Reserve is going to meet, and what's the probability they're going to do anything? Well, if you scroll down through here, says, what's the likelihood the Federal Reserve will change the federal funds rate at the next meeting? Well, just yesterday and the day before, these numbers were in the 90% ranges. So why are they deteriorating from there? Well, don't really know that, but at least it's still almost a 90% chance they're going to cut in September, and all figures are going toward that. Now, the odds of additional cuts are starting to increase. That's kind of intriguing there. And then we have our buddy at Reventure Capital. He is in the news today. God bless the brother. Unsold homes just hit an all-time high in the U.S. South. Now, you have to pay attention to the data here. So I haven't done this data yet, but an all-time high in the South. I looked the other day, and I didn't pinpoint the South, but our inventory, because Reventure Capital told us inventory is at a record high, the highest level ever. I basically debunked that. But let's go down through here. There were 200, well, the gist of this article is the South, especially Florida and Texas, they're suffering. And the reason being is when people were fleeing, and we saw it, when people were fleeing during COVID, they're like, I just need to get out of where I live, and I want to go to Austin. I want to go to Florida where it's nice and sunny. I want to move here, move there, move here. Everybody was transit. Everybody was working out of their homes. So they had the luxury of doing that. Okay, so they flooded certain areas that everybody wanted to live in, and that really jacked up the prices of things. And now it's being stagnant. Prices are way too high, and people are struggling to buy in those areas. So there were 293 newly built homes still in the market in part of the country in June, topping the previous high of 291 set in 2006. So there's the data there. I will still do my research because I don't like trusting these things, according to the new data released last week. Who was the data released from? That's what I really want to know. The South doesn't have a problem, especially in Florida and Texas, and the dynamic might prove an advantage to home buyers in the near future. The glut of new homes will eventually push prices down and remain above pandemic levels. And here's our boy right through here adding to there's a measurable correction already occurring in the market on list prices, but it's still a fraction. It's still a fraction of what their appreciation was, said Nick Gurley. Okay, doesn't he tell us it's crashing every day, day after day after day? Well, it's now he's saying when it's really truly out there in the media, it's still a fraction of what the appreciation was. So again, if you increase your house price by 50% over 2-3 years and you give back 10, is that a crash? I don't consider it a crash, because if my house went up 50%, I gave back 10% of that after a couple years, I'd be like, I'm still way, way, way up. So his tune changes a little bit when he's in front of mainstream media. So just want to figure I'd throw that out there. But if you're out there and you're like, hey, Dan, I'm starting to see some value in my areas. I might be looking to buy my first house. My rent went up. What do I do? What are my first steps? Well, step number one is your credit in line? Are you ready to do this? Even if you're like, I don't really know. Reach out to us. What we are and what I am, I'm a loan officer licensed at ServBank. ServBank is a federal bank. That means I'm licensed federally. I'm licensed in all 50 states as well as Puerto Rico. We're also one of the country's largest mortgage brokers. So that means we can shop your loan up to almost 50 different lenders right now. So it's one application, one credit pool. It's simple for you guys to do. But the first thing, if you're looking to buy your first house, what I want you to do first is click the grant button right up through there. It's going to find you grants up to $6,500. We do have a grant in the Chicagoland area. So if you're in the Chicagoland area and you're looking to buy, please call us, because we have a $10,000 grant for first-time home buyers. Call us and see if you qualify for that. But if you're out there and you're like, Dan, how do I just get the ball rolling? Well, do me a favor. Just click the Apply Now button right through there. It's going to ask you a series of questions. You're going to set up a calendar event with me, David, or Alan, just one of us. We're going to do a one-on-one consultation with you so we can answer all those questions for you before you put in the application. So you can basically make sure in your mind and in paper and on in your accounts, you have enough money to do this. You're financially stable to do this. Your credit allows you to do this. We would love to be your partner in navigating this environment for you. So please reach out to us. Go to therateupdate.com, or if you want to find our phone number, you can do that as well. Just scroll down to the bottom. You're going to see blogs, and you're going to see different programs you can look into. You're going to see testimonials. We finally put some testimonials on there. We have a couple hundred of those. We're adding in there so you can check out our Google reviews. Mortgage calculators, and then right down through here it is. Our 800 number is 844-775-5626, or you can reach me directly, and yes, it's me, at dan@therateupdate.com. Thanks so much for watching, guys. God bless. Have a fantastic day, and I'll be back with the closing bell to let you guys know what the heck happened for today. So thanks for watching. Have a fantastic weekend. I'll see you later this afternoon. Bye-bye.